Hello traders, this is Blake Morrow. You are listening to the week ahead video for July 12th, 2020. I hope everybody's having a safe and healthy weekend. Now before I get started on the things that I'm going to be looking for going into the next week and kind of cover what happened last week, I just want to make sure that you guys do try out ForexAnalytix if you haven't done so. It's only $1 for 10 days. And when you do that, make sure that you download the mobile application. So this way you get the app along with the desktop, platform, just as you log in here. You can have the mobile app, so you can have all of this information, all the analysis right at your fingertips. And if you're not familiar with ForexAnalytix as a whole, let me just cover some things really quick. This is the data flash. This is only available on your desktop. That's going to help you know when news is coming out that's coming up. And as soon as it gets released, it gets pushed here. It's about as fast as Bloomberg, which is great. All right, so all of your analysis on ForexAnalytix is right at your fingertips. All you have to do is click on any one of the basic technical analysis, candlestick analysis, harmonic analysis, Elliott wave analysis, macro analysis. You have your news feed. Your stream of analysis that's been pushed or updated as they are updated, your calendar of what's ahead, integrated Twitter. We have our patterns in play, closed patterns in play. There's a lot to chew on and there's a lot to use here. But aside from your trading platform and your charts, ForexAnalytix aims to be the analysis platform to help guide you along through the markets, and that's what it's here to do. And it's completely customizable as far as all the alerts go, and notifications that you'll receive on your mobile device and on your desktop. So anyway, try out ForexAnalytix. It's great. I hope you enjoy it. And plus, right here, this link right here will launch the chat room, which I'm already logged in, so it's not going to allow it. I've already have it on another screen, which happens to be right here. So once you click on this link over here, it automatically launches this chat room. So I'm going to go ahead and put that up over there and out of the way, and let's talk about first of all, let's talk about what happened last week, and let's talk about the elephant in the room, which is the equity markets. And I was doing an event with Pepperstone Securities earlier today with Chris Weston and a couple other market individuals. It was Saturday morning, and I actually had to get up at 3:45 a.m. on Saturday morning to do this event because it's being hosted by people on the other side of the world. Anyway, it was fun. It was great. It was like just a normal work day for me. But interesting thing is, we were having conversations about equities, and one of the topics were that the equity markets are really driving pretty much everything in the FX market, and it's the correlation's quite strong and very simple. Stocks go up, dollar goes down. Stocks come down, dollar goes up. So, it's easy to identify the direction of the dollar if the equity markets continue to push higher. And if you were like, well, last week was really choppy. Well, if you look at the S&P, the S&P may have closed at the highs of the week, but last week the S&P was very choppy as well. So, we are at a pretty key inflection point where the S&P is going to either break out or we're going to turn lower, going into this next week. Now, I think from current levels, we have about another, 10, 20 points before we hit this is the 127% extension of this last down move. You can see it right here, right? And by, trading above 3,200 on the S&P, now this is the CFD, which is from F.A.C.E, but it's pretty close to the S&P futures. But just if we start breaking last week's highs basically by 10 plus points and close above it, then that means we're taking out the trend line from the all-time highs. So those are the all-time highs back in February. And the stock market continues to climb this wall of worry. I know it's it's baffling to a lot of people, and frankly to myself included. I mean, it's baffling when you think about the toll globally that COVID has taken on not just the U.S. economy, but the global economy, shutting everything down, every major economy for so many months at a time. How do stocks continue to perform well? And the fact of the matter is there's been so much liquidity that's been thrown at the markets by not only the Fed or Federal Reserve, but by every central bank, that you know institutions are just forced to continue to buy, and everybody's chasing yield. Not everybody was smart enough to buy down here. And even you take experts like famed investors like Warren Buffett, that really didn't see any great opportunities, as he said a few months ago when we were here, and he admits that he missed the bottom. I mean, when we were in the face of a pandemic, I think it scared off a lot of people, and as stocks started to turn, you've got markets, everybody's chasing the market higher. And I'm not sure what would fundamentally turn the markets lower, other than a significant resurgence of COVID globally, and another lockdown globally would really probably create a turn lower at this point. Anything less than that, you have to assume that the markets continue to go higher. And then, as we go into this election, into this fall, it's going to be really hard for the incumbent president, Donald Trump, to not take a second term. I know all the polls are suggesting that it could be otherwise, but we have to go with the assumption that Donald Trump is going to get another 4 years, and the markets are probably going to continue to cheer that. So, keeping that in mind, if the S&P continues to move higher and not lower, which that's going to be my base case assumption at this point, then that means that the rally will probably continue in currencies like the Aussie. And here, I had drawn that for something else earlier today. But the Aussie would go higher. And if you look at the daily chart, we'd be moving something like this, and breaking out above the 70-cent level. You'd have the Kiwi dollar that breaks above this resistance. Since we're already above a multi-year trend line, we closed above a multi-year trend line this week. This is from all the way from 2014. The euro dollar, will probably finally break out of this flag pattern and break higher and break this multi-year trend line itself. And I do believe that we have to clear above 114 to get really bullish here, but we're working on it. And there's some important things that are happening this week too. I mean, we do have more chatter about the EU recovery fund. That could be a big driver of the euro going into next week. We have some high hopes that there might be some big breakthrough with the recovery fund out of the EU in time for the European Council summit meeting next week, which is July 17th and 18th. So, that could be the driver that actually pushes the euro higher, and as the S&P, continues to break out. Now, one of the things that we obviously need to pay really close attention to is the NASDAQ. The NASDAQ continues to rip higher, and I pointed this out last week in my blog that we are now really far away from the 200-day moving average. What are these coming from? I don't know what I was drawing at this point, but I'm going to get rid of them. But I want to show you how far we are away from the 200-day moving average. And actually we have exceeded the distance away from the 200-day moving average that we were, to the downside. We are to the upside. And so being that far away from the 200-day moving average doesn't mean that it's going to stop the market, obviously, because the market continues to move higher. But we continue to rally, and it doesn't look like it's stopping anytime in the near future. Now, I have to point out, though, and I have to reiterate, okay, the S&P is at key resistance. There is a risk that we turn lower. All right, there is. And if we do turn lower, we have to assume, and this is where I have to redraw a few things, that the Aussie dollar could fall from current levels, okay? Or the Kiwi could fall from current levels, right? And the euro could also fail from this multi-year trend line from current levels. So again, this whole move is really dependent and reliant upon what happens with equities. Like I said, I don't see a reason for the equity markets to turn lower. I mean, I could give you a multitude of reasons they should. I just don't know if they're going to. I don't know if there's a good enough reason to actually make it turn at this point. All right. I think there's a lot of people that are underinvested right now. That a lot of traders and institutions are underinvested. So the market's going to continue to chase its own tail and run higher. Therefore, the dollar should stay under pressure for the most part. But that doesn't mean it's going to. Okay, because like I said, we are at a huge inflection point with the S&P. Huge. We can go higher from here. We can also turn lower. It's not set in stone, and I'll be the first one to admit we are at an inflection point, really key inflection point going in this week. I mean, what's happening this week that could actually move the needle and really make us move one way or the other? As far as the data goes, we have so much data going into this next week, and if you guys want to follow along via the calendar, you can see all the. Whoops, this is that's already happened, but I'm not gonna go ahead and oh no, this is for going into this next week. I'm sorry, there's Monday right there. You can follow along if you want. But I'll just name a few things that I think are going to be really important. We do have U.S. retail sales. We have also inflation data, CPI, Michigan sentiment is also going to be released. We have employment data out of Australia. We also have employment data out of the UK this next week. And that's going to be on Wednesday, but actually that's going to be, I take that back. That's actually going to be Thursday, because it's Thursday morning out of Australia, because I was just looking on my calendar. It's Wednesday night, but it's actually Thursday morning. You're going to have employment data. You're also going to have UK employment data, which will be early Thursday morning, Wednesday night for myself, and I'll be sleeping actually when that gets released. But those are a couple things that are going to move. But also we have the ECB. Now the ECB, we're not really we're not expecting the ECB to do much of anything, because I think the real mover is going to be any kind of headlines we get on the EU recovery fund going into next week. And I think that's going to be, probably more the determining factor whether the euro, breaks out or it reverses, right? As we head into that EU Council Summit meeting, July 17th and 18th, I believe it is. Okay. One last thing I'm gonna bring up here. Actually, two last things that I want to bring up here regarding the charts. So, and this is something that I talked about last week. And this is the dollar index. The dollar index, and I want you to follow not only the dollar index, but I want you to follow the US dollar Mexican peso, because the charts are very similar. So let me take this away. And if you missed me on the FA.C.E webinar on Monday, you missed this conversation. But I'm going to give it to you guys now, and then we can follow up from there. All right. So we have this bear flag pattern. We're trying to break lower. You can see how the dollar index is clearly trying to break lower. And in my opinion, just like I mentioned to you, the way it's going to break lower is, frankly, the stock market is going to break higher, right? The stock market breaks higher, the dollar is going to eventually break down. So once the dollar index gets below, let's call it 96, this is where it starts to extend lower into new lows. Does that mean that it's going to happen? No, because again, if the stock market turns lower, that means the dollar index is going to turn higher. And you can see the risk here that we're trying to form these lows right through here. We're trying to form those lows. And if the dollar index starts breaking above this resistance, let's call it 97, then the dollar index is going to start to squeeze back towards the 200-day moving average, and quite frankly, we could squeeze even higher than that. And that's when we get put into, a more of a bigger consolidation phase. And this is the conversation we had on Friday. That's why I had to remove the drawings and redraw them for you, to reiterate what I had said already on Friday. Now, what is an interesting chart that I think we need to follow very closely, that's going to help tell the story and really help us understand what's going on, is the US dollar Mexican peso. Let me delete some of these fib levels here, because I was considering doing a lot of intraday trading on the peso, shorter time frames, but I'm going to delete all that. So let's go back over to the daily chart. So, as you guys know, the Mexican peso is an emerging market currency. Now, I know a lot of you would be like, well, the natural inclination is just to sell pesos and buy dollars, because COVID's really affecting Mexico, South America, Brazil, so on and so forth. So you want to buy the US dollar Mexican peso. I don't think that's the reason why you want to sell pesos. The reason why you want to sell pesos and buy dollars is more from a risk aversion standpoint. That means if stocks start to go down, the trade here, in my opinion, is going to be buying the US dollar Mexican peso. It's just like the dollar index. We'd be buying the dollar index as it trades above 97. The US dollar Mexican peso, we'd be buying the dollar MEX above like this 2280 level, on some risk aversion, to be taking out these technical levels. But as of right now, the way it stands, we have like the dollar index. Whoops, I didn't mean to do that. Let me cancel that. What the dollar index has is, the dollar index has that bear flag pattern. Well, the dollar Mexican peso, until proven otherwise, has a bearish pennant. Very similar chart, right? Dollar index, bear flag pattern, dollar Mexican peso, pennant. All right. As long as stocks continue to move higher, the dollar Mexican peso should break lower. We should continue lower. So what's going to change it and make it go the opposite direction or move higher is if stocks start to move lower. So this dollar Mexican peso move here should complement what's happening in equities. All right, so keep a very close eye on what's happening with the US dollar Mexican peso, and also the dollar index. And last but not least, and the last thing I want to talk about is gold. I know I've been a bull for gold for a long time, and I continue to be bullish here. I have to go back and reference, and this is, I got asked on this Pepperstone event that I did really early Saturday morning, this morning, about what's the best trade out there. I actually think the best trade, not necessarily right now, because it does actually look like we're going to come down a little bit in gold, but I think near term, you look at what happened with gold following the GFC, or the Great Financial Crisis, when all the liquidity was added to the central bank balance sheets globally following the financial crisis. Well, my question to you and to anybody else would be, why couldn't we see a repeat of this? But the repeat wouldn't be here. The repeat would be here. Why can't we trade above 2,500 in gold? And not necessarily right now, but I'm talking in the coming months ahead. Why couldn't we? I mean, when you have the risks associated with risks and uncertainty with the COVID. You have economies that you're kind of worried about what's happening with global economies and how they're going to continue to deal with this virus. And then you have all this liquidity that's been thrown at the global markets, you know, the rush to gold over time, and silver as well, as an inflation hedge, as just you know, there's only so much of it, so we're going to continue to acquire gold. Why can't it continue higher? And I guess my argument would be, while we're above like 1700, 1680, I mean, you got to be a buyer on dips. Now, you know, near term, like I said, I think we're going to pull back towards, this is a 38% retracement. It's going to be 1760. But, you know, if I was trading gold, I would probably be using this pullback as an opportunity to be on the long side again, you know, as we're going to eventually, you know, move higher. So gold has not pulled back, and it's not giving people opportunities to enter, and it's not giving shorts an opportunity to exit either. So that's another important concept to understand about what gold is doing. The pullbacks have been very minor, very shallow, and it's not letting people out that are short, and it's not letting people in that want to be long. That's something to really keep an eye on as we move into the next several months, in my opinion. All right, guys and gals, if you think this video is going to be beneficial to you going into next week, make sure you give us a thumbs up on YouTube if you're watching us on YouTube. You know, and subscribe to our channel so you don't miss any of these great interviews that we do each and every day. Dale Pinkert does them on our F.A.C.E webinar. We bring in a lot of experts from all over the globe to be on these webinars for free. So make sure you subscribe to our channel so you don't miss any of the interviews, in case you're not in front of your computer at the time that we're broadcasting live. My name is Blake Morrow with ForexAnalytix. Make sure you give ForexAnalytix a shot. Enjoy the rest of your weekend. I will see you on Monday morning for the F.A.C.E webinar. Thank you very much. Stay safe. Stay healthy. Thank you.